What is going on, guys? Luke here today to give you the 7 deadly investing mistakes you absolutely must avoid at all cost. And there are many of you out there that just got into investing recently. So why would you not when everyone is saying it's easy to make a fortune buying bankrupt stocks? You just log into your app, 10x your money every other week, right? It's actually not that simple. And if you are an experienced investor, I bet you are making some of these mistakes as well. So, you're not off the hook. I'm sorry. You still have to watch the whole video. But more importantly, I will tell you exactly how to avoid these mistakes that can destroy your portfolio so you can make a ton of money in the end. So let's get started. Right now. Welcome back, everyone. In this video, we will cover the 7 deadly investing mistakes and how to avoid each so you can profit big. And I decided to throw in a bonus one at the end that you do not want to miss. It is something you absolutely have to hear. And if you're new here, yes, I do wear my sunglasses at night, because, well, it's fun. And there's no reason why you cannot have fun and make big money. So like the video if you like being a better investor and because it really does help the channel. Now let's dive into this. The first mistake you must avoid, that would be FOMO. I figured I would make the first one easy, but I still see it everywhere, even with experienced investors. So what is FOMO? It is simply the fear of missing out. That feeling you get when Tesla runs up 80% in 3 weeks ahead of a stock split, and you feel like you have to buy now because it will go up even more after the split, then battery day will happen sending it higher, and so on and so on. That's the feeling I'm talking about. You must avoid making investing decisions when you are feeling that way at all cost. And here's exactly how you do that. When you have that feeling, it's time to step away, take a breather, and revisit your plan and analytically look for your next move based on your plan, your strategy, and all that good stuff. Those will guide you to the right decision for you. Which leads me to my second mistake, not having a plan at all. We talk about it all the time on this channel because, it absolutely solves 90% of your investing problems and it answers almost 100% of your investing questions. Having a defined, spelled out plan in writing makes buying and selling and other decisions basically on autopilot. Market crashes? I got a plan for that. If the market runs up, I got a plan for that too. Do I take profits? I already have an answer to that. When do I buy in? Oh, you guessed it. I already have an answer to that too. And my answers were made way beforehand, without emotions or in the heat of the moment. In investing, making decisions on investing with emotions or in the heat of the moment is almost always a bad idea. Having a plan means you sleep well at night no matter what the market is doing because you are in control. And if you do not know how to create a plan, and yes, this is a shameless plug, check out the first link in the description for help with that. Now this next tip is going to hurt some feelings out there, but I'm just being honest and trying to help you in the long run. So the third mistake you must avoid, trying to time the market. Here are the facts. No matter what those stupid ads that pop up on YouTube say with the guy who has a method to nail the tops and the bottoms. Really? No one in the history of investing has ever successfully timed the market and guessed the tops and the bottoms over the long term. No one. Take your pick of the greatest investors of all time. And although they do not agree on how to invest, some are value investors like Warren Buffett, some are short sellers and everything else in between, they all agree that no one can accurately time the tops and the bottoms of markets. So why are you trying? Just because you felt the stock was going to shoot up that day, and it did, doesn't mean you guessed anything. A dead clock is right twice a day. It's why well over 90% of day traders fail, because it's so freaking hard to do. Yes, you could be one of those 10%, but that number also includes Wall Street brainiacs, algorithm traders, and guys with setups like this. Stocks are a long-term game in the end. Sometimes your timing is great, sometimes it's terrible. But in the long run, it doesn't matter. It is much more about buying great stocks than where you bought them at in the end. Every great stock I have bought, even if I bought them at all-time highs, has paid off tenfold over the long run. So buy great stocks instead of timing the market. The fourth mistake you must avoid: going all in on one stock. I know with my Tesla fans especially, this will cause some heartache, and we won't even discuss the Tesla bull. But universally, this is viewed as a bad idea over the long term. You literally have all your eggs in one basket. Obviously, if you really believe in Tesla, there is nothing wrong with taking a huge position in Tesla. But going all in like some YouTubers and others have is not the best way to ensure long-term wealth. At that point in time, you are one scandal, one accident away from disaster with absolutely no recourse. Heck, you're even one law change away from a huge part of Tesla's bull thesis being completely destroyed. Sorry, but it is possible, and it happens all the time. Now, I'm not saying I think that will happen to Tesla at all, and I own Tesla. But I would caution you about going all in on one stock, no matter what stock it is. Now, I already hear the counter argument popping up down in the comments from Warren Buffett fans and guys like Mark Cuban and others who say diversification is not how you get rich. And guess what? I agree with them. But they both would also tell you not to have all your money in one stock. Both of those men and others own a basket of stocks each, not just one. I actually believe Warren Buffett, who is, a subscriber by the way, just in case you were wondering, has 44 individual stocks. And even in his early days of investing, before he had billions or even millions, he still had about 10 or so stocks in his portfolio. So he did spread the risk around even in his early days. He was not all in on one stock. The same goes for Mark Cuban and others. So even though you hear from all of them diversification is not how you get rich, if you just read the headline, you are misinterpreting the message and not getting the full truth. The fifth mistake you must avoid: treating the stock market like the lottery. This is hard to explain to anyone who started investing this year, but a 20% return in a year is a great year. And a 2,000% return in a year is just stupid and abnormal and a once in a 10-year or a lifetime event. It's just not normal. But right now, many investors think you suck as an investor if you don't make 20% in a month, and there are even some who think you suck if you don't make that in a week every week. Sure, it's cool to see a guy in a chat room who claims he really turned $5,000 into $1 million, in a month or two. There's a reason why he's in the chat room boasting about that. Think about it. But I can assure you the chances are just as good to win the lottery as it is to do just that. That is not how fortunes are made in the stock market. They make for great chat room banter among fake millionaires, and even some YouTube videos saying they did it that way too. I'll let you guys figure out who I'm talking about. But nothing could be further from the truth. And I'll leave you with this nugget of information, and then you choose who to believe. Warren Buffett, arguably the greatest investor ever, we'll just say he's one of the greatest ever, has an average annual return of just over 20% over 60 plus years of investing or something like that. So that is a much more realistic target than treating the market like the lottery. And the sixth mistake you must avoid: not considering taxes. How many of you all have bought and sold a stock in under a year and only looked at the profit gained and not considered the taxes on the transaction? Are you taking advantage of trading in your tax advantage accounts like an IRA or others? Do you know the difference between short-term and long-term capital gains tax here in the US and whatever the equivalent is wherever you live? You had better figure it out fast if you haven't. So hopefully those of you that have bought and sold this year have accounted for the tax bill coming due at the end of the year. And it can be a killer. And being forced to sell a position to pay taxes sucks, and guess what? It creates another taxable event. Furthermore, what if your new positions are down a ton when it comes tax time? Do you think the tax man cares? Nope. You still have to pay. The bottom line, taxes suck, but you must account for them. And the seventh mistake you must avoid, and And remember, there's a bonus mistake to avoid you don't want to miss after this one, is not having an emergency fund or cash. It is so important for you to have an emergency fund and cash. And this is really important for you to have for two big reasons. The first, you don't want to be forced to sell if an emergency comes up. If you have an emergency medical expense or any other expense, you need to have the cash to cover it. Having to sell stocks to cover those expenses will destroy your investments and actually create more problems down the road. If the stock is going up, now you sell and now you owe taxes. Plus, if the stock continues to go up, now you have to try to find even more cash later due to the price increase to buy back in. Your only other option if you don't have cash is to use debt. And chasing stocks to keep up with your debt is seriously a bad idea and will eventually spiral out of control. Do not do it. But in addition to having that emergency fund, you also want to have cash to take advantage of opportunities. You know, like the stock market cratering in March due to the illness thing. You can't take advantage of those kinds of drops if you do not have cash. So what size emergency fund and cash pile should you have? Well, the conventional wisdom is 3 to 6 months worth of expenses for an emergency fund, and I keep a cash position for investing in stocks at around 10 to 15% or so of the value of my portfolio. And the bonus mistake you must avoid? Taking financial advice from YouTubers. There it is. I said it, and you know what? I actually almost say it in almost all of my videos. If you are just copying a YouTuber right down to what they have, how much they have, you are missing one vital thing. Their plan, goals, timelines, and financial situation is completely different than yours. If I personally just copied Chicken G, I would not have the portfolio I wanted in 5 years. Now, I'm not saying I'm right and he is wrong, but there are parts of his portfolio that are wrong for me and my goals. Do I still watch his videos and listen to his analysis? Absolutely. His analysis is spot on and it gives me a lot of insight into his thinking and he makes me a better investor. But I always take what I learn from him and I apply it to where it makes sense and how it aligns with my strategy, my goals, and my plan. In the end, guys like Chicken G, myself, and others are just trying to help people and have fun doing this whole YouTube thing and give you guys some practical advice coming from a position of experience on this very complex and crazy world that is stocks. So do not listen to me. And there is actually many other mistakes we could cover, but I think this gives you enough for now, and honestly, no one wants to hear me talk that long. So thanks for watching, and if you want to work directly with me as I show you how to create a plan, set defined goals, how to analyze a stock and build real wealth, check out the first link down in the description where I will teach you my method for all those things and more. And don't forget to sign up for Webull so you can get a free stock. You know, it's free stock. And show your support for the channel by liking the video and follow me on all my social medias I have so you can watch me epically fail on all those. Thanks.